Hello everybody, it's May 24th. This is the weekly review. We take a look at what happened in the markets and try to use what we see to tell us, what to do coming forward. And really this week isn't much different than last and in terms of where we're going, we're just a little bit farther along in the bounces in the world markets, which probably are going to come back in. So, overall, we had a slightly positive, you know, yearly gains are still there. Personally, in our portfolios, we did really well this month as we come to the end of this month. And we did that by shifting our focus to overseas markets playing the ranges, and I think that's going to continue. So that's the theme you're going to hear me talking about again today. If we look at the technicals, the fundamentals, the world markets have been bouncing, and I've said for a while now that it's really not so much about here as much as there, and there being Europe, Asia, and Asia strong. Europe looks like it's going to fade back in here. So let's look at this, and I'm looking at the CACs. I'm on the daily. Let's look at this and try to dissect it. There's a lot going on here. The first thing is, this breakdown bar here got underneath this swing point low. It did it with volume. And matter of fact, even though it wasn't large, it did leave a little volume at the bottom. So there's the potential for us to come back down here and test this again. So that's the first thing to notice. As part of doing that, in other words, when it did this bearish retest regen and got back over it immediately right here, right, that turned this back into the range that we thought it was going to develop. So that was kind of the the check mark, if you will, saying, hey, this is a range trade and we can play the range. And so that's exactly what we did. And I'd have to look back at the data, but I think we sold here and we bought back down here and we sold again up here. We're just trying to play this range, and I expect we're going to buy back down here somewhere. Why do I say that? Well, then we have to continue to dissect. The next thing is there's a low underneath this arrow right here. So that's a retest regen bearish on the upside. And then you've got another one here. And what are we doing? Well, we're in the shaded part, the overlap of those two regions, right? These two regions here. That's where this thing should fail. Now, Friday fell in the sense that it should roll back over. It would be a success in that it's a bearish retest, quote unquote, regen lower. Friday, it got over back under, but it actually had slightly higher volume. Of course, what it's coming into, it doesn't, right? And so it looks to me like this is going to roll back over. Then the question is where does it trade back to? I think the prior swing point high now is where you have to look. Why is that? Well, because that is now a bullish retest regenerate on the upside. So as you fade back into here, then the question becomes, okay, how does this trade? The support zone's back here. That makes sense when you look at it. It's the low of this bar. It's the high of this big spike up bar. That seems to be the area. So I expect probably what we're going to see is when this fade occurs, it's going to come back into this area. And then that potentially is where it holds and gets us pushed back up. So a lot to dissect in one little chart, but that's the way that chart looks, and that also kind of echoes the thought that this range is going to continue to build out. And if that's true, right, these ranges that we have in effect are going to continue to offer opportunities for us to trade them. And if you look at it from just the range perspective, this area in here is the area that makes sense on the way back. So let's keep that in mind. That's the CACs. If we move over to the DAX, of course is set up a little bit different, but somewhat similar. And the first thing we should do is go after the swing point lows and say, okay, where are they? The first one on the way back up was here, and so it's doing the retest regen now, trying to get back over it. It barely succeeded, right, that one day here, but it's hanging there, and so it's struggling. And so this one also looks like it wants to come back. Again, where would it trade back to? Well, it has also a bullish retest regen zone, just like the CACs. And if we think about it, what makes the most sense? Well, the first area is right in here, and then potentially all the way back down here. So let's see how this one trades as well to give us a clue. That's Europe. And I'm going to stay on this theme because it really, as I've been saying, it's really about there versus here. So let's go over to Hong Kong. Now, Hong Kong never got back to that area we were wanting to see, right? And that was this little zone back down here. It instead held at the higher support range and has now pushed back up off the strength that took place in China on Friday. This, of course, is a range right now in this area, right? And it's right there testing the top part of that range. So the question right now is, okay, is it, let me redraw that because actually the better redraw is here. And that's not true, it's too high. Yeah, I think the one we had before is better. So anyway, it's right at that center mark, and it's trying to get back over it into the higher range, and it's barely peeking into it now on this particular time frame and on this range that we just drew out. Now, the strength, of course, is Shanghai. Shanghai was up like 8% last week in the large caps, 12% in the small caps, and it just finished another ABCD structure to the top side. And so now the question is what does it want to do now? Now that it's over the high, can it continue to push up, right? Can it spike on up, or does it come back and do a retest regen zone itself on this immediate, on this high? So China will be the wild card this week in terms of the strength picture. Can it push higher or not? That's where we should be focused and looking. If we look at one other one, that's Japan. The yen has been crumbling, right, and is trying to break down. Japan is right here at the highs, just barely got over it on Friday. This also is a key market for us to watch to see what it does on the way back down. Of course, this, or not on the way back down, but does it come back down? This, of course, finished off an ABCD structure and then just kept extending. This one looks overextended to me, but really, the key thing here, of course, is the currency devaluation. And if we pop over here to look at the currency devaluation, you can see that it's breaking down, right? Just broke down. This is going to be the key on the Japanese market. Does this continue to the downside, or does this pop around and stay back in the range? And this is a big deal because this is on a weekly time frame as well. It's trying to break down multiple time frames, multiple swing points, and in doing so, it doesn't have the volume. So to me, this is the key test this week for the Japanese market. In Asia, it's Japan, it's China right now. Those are the two questions we're going to have to watch as this unfolds this week. So Europe looks to come back in. China, no clear clue that it wants to come in, even though it's extended. In terms of the projection, it's done its projection, extended a little bit beyond it. And Japan, also not clear that it wants to come back in, although this does look like it's going to fail and stay in the range. I want to come to that later, so let's go back here. All right, so ranges everywhere. China, I just talked about. U.S. stocks really are kind of stymied here at the highs as a result of the strength in the rest of the market and the weakness in the fundamentals here in the U.S. And so even though we made this new high, we couldn't extend on it. It looks to me like this is going to try to come back in just like Europe and do a bullish retest regen. And I'm on the S&P 500s. And if you look at it on a weekly, right, it's just a slow extension up. If you go back and look at this thing, other than that big drop spike in the weekly, right, back in October last year, right, it's just been a slow, steady, I can't get any kind of real momentum, move on the way up. It just keeps grinding up. And that grind up, of course, is, I think, a big part of it, the world markets and all the QE going on there. but it's also the corporate buybacks, right? Because they're kind of price insensitive. They just keep buying. And in the fact that there's no volume, you're getting enough out of that. And of course, merger acquisitions are still happening too. And nobody wants to leave the market. There's no place else to go. And you know, to me, those are the things that keep grinding this thing higher. Slow, steady, belabored, but still a grind higher. Okay, let's go back here. Dollar range bound. That's a big deal, right? Because you know, if the dollar starts to take off, that of course is going to put some juice underneath the other markets, but it's going to weigh against our market. It's going to continue to do that divergence that we're seeing between world markets and us. So the dollar gets over the swing point high. I'm on the daily chart. That's now going to be a bullish retest, regenerate when it comes back, right? And I suspect it will come back fairly quickly. It does, or it is trying to push back into this bearish retest regen zone. So I wouldn't be surprised to see it get into that zone, fail, come back, and just be range bound. The key thing here is so far, at least on the daily, you know, you haven't gotten back over a swing point low completely. And those lows are overlapped right here, so that's where it's trying to get to now. Once it gets into that area, I suspect that's about as far as it's going to get and get a retrace. Let's look at it on the weekly, and the weekly high 2508, and it got over it, so that of course does tell us now that yes, we've got some sort of a range trade going on, which is what we thought would happen. The two areas look to be about here. And so there was a little bit more to the downside potentially. Actually, you could probably divide this up into three. It would be cleaner. There's this area. There's the one under it to that high, and then the one under that high, right? And so we're right there trying to get back into the middle one. So that's the dollar. The dollar being range bound is a good thing as long as it doesn't go crazy to the upside or crazy to the downside. I don't think the dollar is the big factor right now. Yes, as it goes up, it will kind of hurt the S&P, but I think the S&P is being driven by the world more than the dollar because the dollar is in the same range still. Markets near the highs other than the Russell. We should look at the Russell real quick together. You know, this to me continues to be the story on the domestic markets, and that is that, you know, the Russell is much more attuned to whether or not, you know, the economy is doing well here in the U.S., and I think it's a clear indication that it's not. And so Russell, you know, it's not terrible. It's over the highs. It's still holding them. It's retested and regen twice now on a bullish and held. But boy, is it having a hard time. Came off this bar. I guess it can get to back to the top, you know, in terms of where it can go because it held the bottom. But this thing at best is range bound as well, and struggling even though it's up here near the highs. So again, it's positive, but it's not where we want to be. That's kind of what I've focused on lately, and I think we should continue to focus on. Another negative on the technicals we saw this week was the breakdown finally in the IYT, and so let me pop that chart up. The transports, they break down on the daily underneath these two swing point lows, and now they're going after this weekly swing, this daily swing point low down here. If you pop it to the weekly, underneath that swing point low on the weekly, and what is this? 1, 2, 3, 4, 5, 6. Yeah, this should print pretty soon. And then the key thing here, though, is that, you know, here's another major sector that looks like it's going to start working lower. And where's it going to work to? It's going to work back into that October low. And so it's the high of the low. That's where you should expect this thing to try to get to. And let's see. Okay, so that was it for the sector. World markets I talked about already. Domestics I've already talked about. The dollar, I think it found the bottom of the range. Fundamentally, you know, I already kind of said this, you know, the buybacks are a huge deal. The other thing that's a big positive is just the fact that nobody else, any place else to put their money. And the other big thing that could be a positive or a negative, and I've put it as both, is this Greek drama is drawing to a close. One way or the other, something's going to happen. Either they're going to bust or they're going to reach an agreement. And one's a positive, one's a negative, and I don't know which one it's going to be. It looks to me like Europe's going to pull back. Maybe this is going to factor into it for now, but that's going to be a positive or a negative one way or the other, and it's coming to a close. It looks like to me. World growth still muted at best, especially here in the U.S. And we're going to get some more numbers into the week. We'll get the industrial numbers, the PMI numbers, the flash numbers coming for the next month, starting on Saturday in China and Japan, and then again here, not this week, but the following week. So a bunch of numbers be coming up pretty soon. If I ask myself, what am I going to watch? I'm going to watch those two Asian markets to see if they can keep struggling higher or pushing higher, and I'm going to watch, and that's Japan, China, and I'm going to watch Europe to see if they can pull back. The euro getting stronger off the dollar pushing higher, I think, is going to hurt the European market, but then again, I think the dollar is still range bound, so I think that range is still going to play out. There's an immediate retest region that we talked about just a second ago on the S&P and the Dow. That will be something to watch as well. So it's really, do these head back? And I could also add here, does China and Japan keep rising, right? Those are the things I'd be looking at this week. Economically, there's about 4 Fed speakers this week. There's not, there is some data, especially on Tuesday when we get back. There's not a lot else going on. These are second revisions on GDPs. I don't think they're going to be a big surprise. A little bit of data on Thursday, but the PMIs out here, on Friday, but the PMIs out here are going to be the key thing, and those are going to start popping up this weekend and then, of course, next week. So that will be the biggest deal coming up in terms of the economics. Fundamentally, we just can't go down. But, we can't go up. It's a struggle. But we won't go down, right? And so you kind of got this dichotomy domestically where these markets are having a hard time doing anything other than just barely grinding higher. We're still early enough in those ranges, if you think about it, and I'm talking about Europe and Asia, and the range that's still in effect in Asia, but we're still early enough in those, given the size of the move that took place, and I'm going to pull up the chart here as I talk, the size of the move that took place, and I'll just pull up France because it's been the strongest one, and we'll go to the weekly. This was a big move, 30% or so. So that move up, it's going to take a while to digest it and to go sideways, and that's what it's doing. As it does that, there's opportunity, which we've talked about, which we've been taking advantage of. Now, we have to realize that, this kind of a move can actually come all the way back in. And so we could see it come back in and do a retest region off that prior high in the breakout here. And so this area here is still game. We have to realize that as part of our plan. And so we don't want to get so excited that we try to put all of our money to work up at these levels. We have to save some in case something comes along and drives these markets lower and creates an even better opportunity to buy. But they're early enough in the range probably going to continue for a while longer. That produces opportunity. That's what we should be looking to try to take advantage of. So technically, domestically here, and I really should say domestically, we can't go up or down, or we won't go down. They're still early enough in these ranges elsewhere that we should try to do our bidding, our buying, our selling in most of those. We can still work the stronger stocks here, which we are, but don't expect this market to just push higher and higher and higher. I don't think that's going to happen domestically. As long as those ranges build out in Europe, nothing major happens, we're probably going to stay in the ranges we've already started. If Greek barfs, Europe could take that big dive, on the fear. If something happens in the U.S., we could take a dive here as well. There's various factors that give us that dive to give us a better opportunity, but we should look at that as an opportunity. In other words, If we were to see a 10, 15, 20% dive, it would be a gift. That would be the time for us to put our money to work. It's what we keep waiting on. That's why we keep our footprint low. But the fact that we have a small footprint, in other words, a small portfolio, and we've only been getting up to 40, 50%, and then we draw it back down at the top of the range or towards the top of what we think the range is, that allows us to make the money, right, but to keep enough money around to where if we do get something happening to the downside, we're going to be able to put that money to work and put it to work in a larger way. And I think that's what we have to keep doing in the next month or two, maybe 3 months, waiting to see if we can get something bigger to work with, but keep working that range in the meantime with some portion of that portfolio. Fundamentally, GDP growth will have to come from consumers. You know, that was this chart I was popping up earlier, and let me pull it back up. If you think about the GDP, we don't have robust growth in the industrial sector and manufacturing. It's not happening. It's not happening here, and it's not happening around the world. If you look at the gross domestic product, the largest part of it already is consumers to begin with. And so manufacturing isn't going to provide the boost, so the boost has to come from the consumers. Well, how can you measure whether consumers are going to spend more or not? Well, I think the easiest thing to do is just go over and look at the personal savings, right? And so I've gone over to the FRED database, look at personal savings. This is back from 1960, and you can see that there was a savings rate increase into the 70s. Then, you know, all of that started to change, and the money started getting spent, and said you had this large retrace, and that happened from the mid-70s all the way up until the mid-2000s. Then savings began to work its way higher, big spike up and spike down off the rates, off the crisis situation that took place here, right, with the recession, a spike up, and then we had a big spike in 2012, and since then it's came down again. But I'm not sure that this trend really has reversed. I think it's still heading this way, and if we see this start to spike up, that's going to hit the GDP numbers, and people are going to be very disappointed, and they're going to think that, you know, things are worse than we think they are. And so I think that's the thing to really be watching, you know, as we go forward over the next, you know, few months, is does the spike or does the savings rate continue to increase? And if so, that's going to put pressure on the GDP, because I don't see it, you know, getting increases from elsewhere. So I kind of wanted to point that out, because I think that's a fundamental thing that we should be looking at, because these unless we start seeing manufacturing pick up, which I don't think we're going to, it's going to have to come from consumers here and abroad. And if that doesn't take place, if we see that savings rate start to increase, I think those GDP numbers in the third, fourth quarter are going to be bad, and I think that's going to weigh on the markets. And I've already kind of talked about this. Let's go to the portfolio. I don't really have a lot to talk about in the portfolio. You know, this is kind of where, you know, I think that we continue to do what we've been doing. And, you know, if you go back, and I think you're all aware, and I'll pull this over just in case you're not. Let me grab this and pull this over to the TA Today site. You know, if you come in here and you come to portfolios, you can actually go down and you can look at closed positions, which will show you what's happened. Blow it up a little bit. Will show you what's happened, you know, for the month. So this is May, and you can see it's about 1.5% so far this month. You know, gains. We booked a pretty good amount of that, and so the real key here is, you know, what happens going forward. And so, you know, I would want to continue, and you can also look at where's the performance. I was going to show you this one, historical. You can always go into here as well, right, and you can look at the performance overall. You know, we've more or less kept up with this market. Not a great year, but not a bad year. And, you know, we've kind of kept up with what the market's doing. And we've done that in a very safe way comparatively, right? We're not out there taking these big swings, even though the market has done that. And as long as we continue to play these ranges over the next couple months, I think we can continue to bang out these gains over the next couple months, waiting for a bigger opportunity. So, the thing I wanted to push across here is that, the portfolio, even though we're not a big footprint, we're able to make some gains, and that, in this kind of a market, is not a bad thing. So I expect this to continue longer. I expect to continue to do it. Summary, last week we took a bunch of profits. We still got that GLDI trade that I screwed up at the beginning of the week. We still have just the short in place. We want to spread that, and we're going to want to spread that with a short on gold. And let's see what else. So we added Asher and we sold some right quick. I'm still looking at these on the range trades. There's really not much to summarize here. We just took a bunch of partial profits, right? We're waiting on a larger retrace on Zeltique. GLDI, maybe I should look at this one more time with you since I flubbed it up so bad at the beginning of the week. So we put this on at the beginning of the week with GLD, realized that I screwed up, took it back off of the GLD on Tuesday, took a loss on it. This one actually, even the gold itself, and if we look at the gold chart, even though gold itself has been drifting back in a little bit heavier, GLDI to some extent is spread already because it got covered calls inside this thing. So, it's driving income. As long as gold doesn't sell off hard, then this thing will outperform, and that's what it's doing. But at some point, we want to put on a short, right? When we think that GLD itself is as high as it's going to go, or at least put on a partial short as it goes higher. So if GLD this week, and it's actually holding this range pretty well, if GLD gets a reason to spike up, let's say the dollar starts to pull back and it gets back up here towards the top of the range, then that would be the time to come in and look at putting on a short on gold. And I've started looking at, let me find it real quick here. I've started looking at, I got one of the members said, I don't want to go in GLL because that's a K1, and I don't want to deal with K1s for tax purposes. And so he suggested, that member suggested a different stock. I didn't like it because it was a 3-to-1. So I looked out here and I see that the DGZ also does not issue K1s like GLL does. It's a 2-to-1 just like GLL, and actually it has more volume, and I had not seen this one before, so this looks like a better opportunity here. What we'd like to do is buy the inverse, right, as this thing trades lower back into these lows. And so you're going to see me put on a trade at some point. Hopefully I don't have to put it on up here, but if I have to, I will. What I want to see is gold make a spike back up on gold, drive this thing back down. Let's put on partial shorts back here, and then we'll have that spread in place. So that's what I'm looking at there and what I'm trying to do and waiting to do. And I think that's about it for the summary and for this week. Not a lot to talk about this week, even though it took me 30 minutes. In general, same things going on. Same trades are in place, same ideals are in focus. We need to keep doing the same thing, keep banging out profits, and doing it with a small footprint, lower risk, and waiting for a larger opportunity. If that doesn't happen, if things start changing, then we'll modify what we do. But right now, I think we're doing the right thing, and that's what we should continue doing. Thanks a lot. If I can help you, give me a holler. Take care. Bye.